In this video, we're going to look at the income statements of a service company, a merchandising company, and a manufacturing company. The income statement of a service company is a simple single-step income statement. They'll list their revenues, less expenses, and calculate net income or net loss. The expenses will have no inventory related expenses because the company does not have any inventory. Next is the income statement of a merchandising company. This income statement is a multi-step income statement. So they'll list the sales, that's sales of products, and then sales is typically net sales. But for the purpose of this class, we're not going to go into net sales, but sales. And then they're going to subtract cost of goods sold to come up with an item called gross profit. Sales minus cost of goods sold is gross profit, and then from gross profit, they're going to deduct the selling and general administration expenses to come up with net income. This is the format of the income statement we saw in financial accounting. But for managerial accounting, we're going to go a little bit deeper. We're going to expand this cost of goods sold to look at the calculation of how to calculate cost of goods sold. So basically, let me get the pen and show you what I mean. This particular line item here has been expanded to include all these items. So basically, to calculate cost of goods sold, you're going to look at your beginning merchandise inventory. That's inventory on January 1st of the year. If it's a month, it's of course the beginning of the month. Then you're going to look at the cost of merchandise purchased, and of course this includes freight in. That gives you a number called goods available for sale. From that, you're going to subtract ending merchandise inventory to come up with cost of goods sold. This is what we've learned before in financial accounting. I'm going to draw a T account and show you where we get these numbers. So we've done T accounts in financial accounting. So if you look at your inventory account, and when I say inventory, of course, it's merchandise inventory. We have our beginning balance here because inventory is an asset. Our purchases of inventory are here on the debit side. Every time we sell inventory, we transfer it to cost of goods sold, so that decreases our inventory, and then whatever is not sold is our ending balance. Well, all this is just writing it down in the form of a schedule. Here is your beginning balance of inventory. Here is your beginning balance of inventory. Next, purchases of inventory. I'm going to label that 2. That goes here. These two added up, we know what's called goods available for sale. And what we want to do is we need to find cost of goods sold. So instead of subtracting cost of goods sold to come up with our ending balance, we're going to subtract our ending balance to determine cost of goods sold. And I'll show you how that equation works in a minute, but this is 3. So this is ending merchandise. I'll label that 3 here, and that gives us our cost of goods sold, which is 4th item here. So all we're doing is presenting a schedule of our T account. Let's go back to our T account. We know in our T account, our beginning balance plus purchases equals cost of goods sold plus ending inventory. So to figure out our cost of goods sold, all we're doing is we're subtracting ending inventory, so we get beginning balance plus purchases minus ending inventory equals cost of goods sold. And this is really what we're putting in our income statement up here. So when you're doing your homework for this particular chapter, you would probably be using the income statement in this expanded format. Next, let's look at a manufacturing company. The income statement for a manufacturing company starts at sales less cost of goods sold, gives you gross profit. Then you subtract selling and general admin expenses to come up with your net income or net loss. Does this seem familiar? If we look back to the income statement of a merchandising company, the condensed version of the income statement looks identical. However, if you go look at the details of how cost of goods calculated, it does look a little different. So for the merchandising company, we had cost of goods sold calculation where we looked at merchandise inventory. In the manufacturing statement, we're going to look at cost of goods sold in the finished goods inventory account. So to calculate cost of goods sold for a manufacturer, we start with the beginning finished goods inventory account, and then you add your cost of goods manufactured. That gives you goods available for sale. From that, you subtract the ending finished goods inventory to come up with your cost of goods sold. And then the cost of goods sold is subtracted from sales to come up with gross profit. We have not done the T accounts of a manufacturer yet, but the finished goods T account, and in fact all the inventory T accounts, are going to look very similar to the merchandise inventory T account. It's going to be the same format, except the words are going to be slightly different depending on the type of inventory. So when you are working on your questions for homework on a manufacturing account or manufacturer's inventory, this cost of goods sold calculation is all of these items combined. That's it for this video. If you have any questions, please let me know.